Ladies and gentlemen, welcome to our AMAS webinar on shortening the settlement cycle to T+1, which we have organized together with our appreciated member State Street. The shortening of the settlement cycle to T+1 for North American securities is already scheduled for 27th, respectively 28th May 2024. Firms all over the globe are evaluating the significant logistical and technical challenges that accelerated trade settlement, especially in the United States and Canada, will have on their IT systems and operations. The successful transition to T+1 will require immediate technological, behavioral, and operational changes. AMAS continuously is addressing this issue and conducted the first webinar in June of this year. Recently, we published the circular number 4/2023 on the topic Settlement T+1 on 22nd of August this year. Today, we are very excited to hear practical insights and specialized approaches to meet T+1 requirements from several subject matter experts from State Street, located in the United States, as well as in diverse European countries. At this stage, I would like to say special thanks to Florian Wiedmer, who is present locally in Zurich and an active member of our AMAS Specialist Committee Process and Operations, for establishing the contact to his colleagues from State Street Corporation in the US. A special thank also to James Strachan, who is joining us directly from Boston, Massachusetts. James coordinated the compilation of the technical topics with the individual subject matter experts. And of course, also a big thank you to the people engaged into this webinar who have spent their time and efforts to set up this event for our AMAS members today. Guys, this is very much appreciated. I will now hand over to James Strachan. James will provide you with some background information about State Street and the business fields they endeavor to deal with the challenges to shorten the settlement cycle to T+1. James also will introduce the following speakers and their individual subject matters to you, and he will be the moderator of a subsequent panel discussion with selected questions from the ranks of our AMAS specialist committees. During all this, you, ladies and gentlemen, will also have the opportunity to ask questions. Please use the Q&A function below the screen. In German, you will find a F&A button for Fragen und Antworten. James, the stage is yours.
Thank you, Stefan. Thank you to the AMAS for inviting State Street to present today. Very important topic, T+1, both in the US and Canada. By way of introduction, I am a member of the North American product management team here at State Street and a member of the T+1 project management office and a member of the steering committee, the executive steering committee from an enterprise program office perspective. With me today for today's webinar, I have my colleagues, Claire Williams and Austin Armstrong from our Global Markets FX Sales and Trading team, and Kieran Fitzpatrick from our ETF Product Solutions team, and Kristen Schultz from our Securities Lending Finance team. Today, the team and I will provide an overview of the State Street Enterprise T+1 program, the impact of T+1 as it pertains to the different business lines within State Street and the clients we serve. With that, I'll start with a high-level overview of State Street as a company. State Street is, as you may know, is based in Boston, Massachusetts. State Street is a global financial service firm with processing locations in North America, Ireland, UK, Europe, Eastern Europe, India, and China, with assets currently under custody of close to 40 trillion and 3 million in assets under management. We serve as a firm 41% of all mutual funds and have approximately 43,000 employees worldwide, with a presence in 100 geographic markets. We are the third largest ETF provider and #1 ETF servicer and the fourth largest asset manager globally. Our capital and liquidity ratios, I won't go into these at this time, just give you a high level, and information is available on our annual report. Slide 7 articulates State Street Global Markets, which is our capital markets business, and the three pillars of their business: liquidity, finance, and research. Turning to the topic at hand, T+1 and accelerating the settlement cycle from T+2 to T+1. State Street as an organization has launched a program management office in January 2022 to address the new SEC regulation for shortening the settlement cycle to T+1. The Program Management Office is governed by an executive steering committee to provide governance and direction over the initiative. The steering committee also coordinates and manages the various work streams associated with technology, operations, and process development across the different business lines at State Street. The PMO has gathered metrics, scoped out potential changes, and budgeted for internal systems improvements, testing with the depositories in US and Canada. The areas included in the PMO are operations teams in the US and Canada, asset servicing, ETFs, middle office, our global markets business, such as the FX and securities lending business, as well as the custody business. Each area has conducted an impact assessment on their technology and operations to support their business and identified new IT operating model and service enhancements. We've also conducted various client outreach programs to analyze any technology and implementations that our clients may need to make to adopt a T+1 environment. State Street is also an active participant in the industry working groups such as DTC North American Advisory Council, the ICI, SIFMA, Association of Global Custodians, Canadian Capital Markets Association. These forums are all industry forums where broker-dealers, asset managements, and custodian bank communities come together and share best practices to provide commentary and collect information and discuss changes going forward. Our advocacy program has published a series of thought leadership articles dedicated to T+1, with the contents articles posted on our corporate website, and our office hour sessions have been held as a source of information for clients and the industry regarding the topics in industry changing. Many of these points are covered on this slide 9. The next piece I'd like to cover is the custody and settlement piece, which is a very high impact area for T+1. The main focus in the US market has been the pre-settlement process in the trade life cycle. In the US market, there is a process called affirmation, which is the consummation of the executing broker and the buy side matching and confirming and agreeing the economics and details of the trade and place of settlement. The process has historically, in a T+2 environment, been completed in the morning of settlement date -1. And in the new environment, in a T+1 environment, the affirmation deadline has now been moved to 9 p.m. on trade date Eastern Standard Time. DTC is effectively removing 10 hours from the deadline. The affirmation process has come to the forefront of the T+1 initiative due to the regulators in the U.S. mandating that U.S. broker-dealers have their trades affirmed on trade date. This is referenced in 15C6-1, which is a reg that the SEC recently came out with earlier in the year. Historically, the affirmation process has never been a concern due to the extra day in the settlement cycle. The benefits of the affirmation process is that it promotes straight-through processing, and has the ability to reduce errors on settlement date, which is one of the foundations of the push for T+1 to eliminate counterparty risk in the marketplace and reduce costs in the marketplace. The slide I'm showing here on the screen now articulates the three affirmation models that State Street supports in a T+1 environment. These are three models that are currently supported and we have had in place for quite some time. The part that will be changing in the new T+1 environment is the cutoff times, as indicated on the second line of this slide. The three models here are the model number one is a self-affirming model for investment managers looking to take a hold of the affirmation process themselves. The second model is delegating the affirmation process to State Street as the affirming party. And the third model is where no affirmation is required, or the investment manager or client does not feel that they need to affirm. There is an appendix on this slideshow that it provides more detail on the affirmation process, the operational impacts, and the practical steps to answer some of the questions on the affirmation process and the models that State Street supports. In the appendix on slide 27, there's also a description of the SEC rules to reduce risk and clearance and settlement in the U.S., which specifically applies to broker-dealers and the investment management community. Firms should assess their responsibilities with their legal and compliance teams to understand their responsibilities as it pertains to these SEC rules. So with that, I'll turn the presentation over to my colleague, Claire Williams, for the piece on foreign exchange considerations. Thank you, Claire.
Thank you, James. Thank you. As has been discussed, the shortening of the settlement cycle for US and Canadian securities from T+2 to T+1 is scheduled to take effect from May next year. This means that for foreign investors who will require FX to fund the purchase or sale in US or Canadian dollars from their local currencies, the window for security trade matching and the generating and executing of their FX conversions is going to become very compressed. With less time to settle security trades, global firms trading in the affected markets may need to simplify and automate their FX processing to reduce the risk of failed trades and overdrafts. We are encouraging managers to look at their FX in conjunction with their security workflow to align the timing of their FX funding needs. Managers should consider and understand their current FX process and identify any manual components, as we believe the key to solving this is going to be having as much automation in place as possible. Where as a manager you are based is going to have an impact. The move to T+1 is going to be particularly felt for those managers in both Asia and Europe who are not transacting in US or Canadian dollars. With a greater emphasis on key parts of the life cycle of a trade and its subsequent FX occurring after the end of the Europe day on T, more firms are looking for that greater support during the afternoon and evening in the US and are evaluating their coverage from both an operations and trading perspective. European managers need to assess at what stage and when in the life cycle of the trade are they looking to execute the subsequent FX that may be required for settlement purposes. Currency deadlines and liquidity are going to play a large part in this. For example, a European asset manager with an Australian-based fund may execute a security transaction in the US market at 5 o'clock London time. They will then need to execute the Aussie dollar conversion. They may require US coverage to be able to execute the FX on T. However, if they wait to execute away from their custodian the following morning when liquidity improves, they may have missed the same day cutoff time for Aussie dollar. So for clients who wish to retain the FX execution process themselves, executing currencies with early cutoff times will become much more challenging. It also needs to be considered that with more FX activity being priced on a T+0 basis, this opens other risks, such as less ability to utilize risk mitigation infrastructure, such as CLS. The market indeed may be pushed to a much increased volume of FX settling bilaterally, which could be seen as a backward shift in our ability to mitigate settlement risk, a key principle of the FX Global Code. Liquidity pools, particularly around the end of the US trading day, usually seen as a relatively low volume period, known by some as the witching hour, may need to move or widen, but that is not a certainty, and indeed may not be seen to start to happen until T+1 has actually come into fruition. It also lends the question as to the spreads that may be applied if the liquidity is lacking. Pre-funding is a viable alternative solution and would certainly help negate the need for same-day value FX executions. But not all managers will be able to pre-fund or can't necessarily hold excess cash in all currencies. And pre-funding can result in cash being tied up for longer than is necessary, and so is not always a viable or practical solution in the longer term. How managers process their FX will have an effect on the changes that they may need to make to better comply with the compressed settlement cycle. Those who manage the process themselves in the market with multiple liquidity providers may face a different issue to those who outsource the process to their custodian or another provider who can utilize a more automated solution to identify the need for security settlement related FX activity and provide its execution. Clients who already have an automated solution in place for their FX will obviously be less impacted by T+1 and should work with their custodian or provider to ensure that all factors of the FX lifecycle have been considered and are suitable for the manager's specific needs and workflow. T+1 definitely increases the risk of failed settlements when executed away from the custodian due to the need for settlement between banks. Therefore, managers who wish to retain their execution processes themselves will need to ensure they have the right coverage and technology in place to be able to support this. A prediction is that this market change will encourage managers to focus more on the custodian FX solutions, where clients can look to take advantage of increased automation and friendlier deadlines than may be seen on a third-party basis. In fact, rules-based trading solutions will assist in bringing clients more comfort being charged, especially at times where liquidity could be impacted. Of course, there are benefits to the move to T+1, as a shorter settlement cycle aims to improve efficiencies and reduce the risks and counterparty credit exposure for both investors and market participants. Indeed, it should be looked at as a positive that this may force firms to automate those legacy manual processes and upgrade technology, something obviously better for all in the long term. particularly considering the likelihood of other markets following suit once the scheduled moves have played out. State Street Global Markets has a couple of solutions for T+1, including indirect FX, our highly automated custody FX program for clients who are custodied at State Street, and Street FX, a rules-based FX execution service agnostic to custodian that enables investment managers to both define their FX execution strategy and completely automate the FX trade execution lifecycle. Street FX can receive instructions directly from your order management system or middle office provider to allow execution of the FX order once the underlying security trade matches. We have also implemented direct linkage with DTCC, as you can see on the slide shown, so that we can quickly and automatically receive a copy of the security trade settlement instruction upon matching in CTM and M2I. May I have the next slide, please, James? Thank you. This results in a fully automated, fully transparent FX solution with all the parameters of pricing, including pricing times and the spreads charged, pre-negotiated at the beginning of the relationship, giving clients consistency in their FX execution. We are also developing a Street FX dashboard to allow clients access to real-time monitoring of FX orders from receipt in Street FX to executor status, as well as providing comprehensive reporting through our TCA provider, BestX. We believe that State Street's FX products can help managers tackle the T+1 conundrum with their high levels of integration, automation, and flexibility. With that, I'd like to thank you for your time today and pass over to Christian to continue the discussion.
Yeah, thank you for handing over, Claire. So on the finance side, I would like to deviate a bit from the slide, right? The slide gives you a bit of an idea what we do at State Street with regards to T+1 settlement in securities finance. But in fact, like if you look at the product at the first glance, you could probably have the imagination that there's only limited impact from the T1 settlement, because in reality, the whole industry is already working on T1 or T0 on a regular basis anyhow. But this is just like best effort, right? We tried to settle T1 or we tried to settle T0, except of US Treasuries, obviously, but it's not a guarantee, so to say. So the reality looks a bit different. In reality, it's like the devil is in the details, so to say. Like if you look at recall management of securities lending trades, for example, or cutoff times for instructions, real-time versus batch processing, custody, third-party agency lending, these things all come together and makes the picture look a bit different, I would say. Like depending probably on the model you're using, if you're a principal lender or if you're an agent lender, if you're agency lending and have your agent lender as your custodian as well, or if you have a third-party agent lender, the focus probably shifts a bit from what's more important to you. But in fact, it all comes down to two main points for T1 settlement. One is operational efficiency, and the other is, do you have the critical mass to A, get the investment to make your program up and running, and B, are you able to operate the program in a way that you can deal with the shortened settlement life cycle, so to say, right? So if we look at operational stability, it's absolutely crucial to make sure you avoid any delays in your securities lending program. So what could these delays probably come from? So a standard agency lending program is usually using a batch processing. So you collect like data over a certain time. Let's say like you select all the sales of your clients for the next hour, and then you process it all on a batch. Then you wait for the next hour to collect the next data, and then you process. Like if you are on a T1 settlement only, you do not have the time to wait for something. So you have two ways actually to avoid like any delays. The one is you shorten the period in between the two batches. And if you reduce that to a bare minimum of, let's say, 1 second, you actually get to my second point, which is the second solution, that you just move to like a real-time processing of all the order flow in the program. And when I say order flow, like the classic is you as an asset manager, you run like an agency lending business with, in that case, State Street, for example, we are your custodian. So what happens is you sell some of your assets. We book that into the custody system. As soon as it's in the custody system, my trading desk sees that these assets are sold, right? So we have to recall them from the borrower. If we can see that in real time, we can act very quickly. If we only see that with a delay, that's not optimal. And if we process it with a delay in addition, that's even worse. So one thing, if we are the custodian, that might work somehow, not optimal. But if it's in third-party lending, this problem becomes even more pressing, right? So if we are not the custodian, we already have a delay in seeing when something is booked. Hence, we have a delay in recalling it, and that makes it somehow difficult. So again, it all comes to the point, like, is your lending program operationally stable? And then the second point is basically critical mass of the program. So if we are talking about critical mass, I was like, it's probably a bit of talking my book, but I had like last month, there was an ISLA roundtable in Frankfurt, and we were discussing about entry hurdles into securities finance business. So what is the minimum assets under management you need to run a securities lending program yourself? And there are obviously some like technical requirements that you need. You need a front office system that is able to handle securities lending and collateral management. You probably want to have NGT, so Equilend in place in order to lend your GC, general collateral assets. So the assets that you have en masse in your portfolio, but which yields very low, but as the portion is so big, it still makes a substantial bit of your revenues in securities lending. This is usually run straight through processing. So you need a system for that. And usually you buy one, so you have to pay the vendor for that. On the collateral management side, what are you doing? Are you running it bilaterally, or are you running it in tri-party? And if you have a tri-party agent, you have one or two, because probably one of your counterparts is just working with one of them, right? So you need to have two. And this needs to have like an interface to your front office system as well. So this costs in addition. Then you have different data vendors in order to see if the pricing you receive for your assets is really the pricing that you can achieve in the market, or if you want to lend out only specials, that you know which assets in your portfolio are specials. So long story short, this, in addition to having like a real-time processing system, increases your cost further and further and makes the entry burden even higher. So that's like the point of critical mass. If you're not big enough, it's probably better to have an agent lender doing this business for you, and it becomes more pressing with the T+1 settlement cycle. Again, it's a bit talking my book, but from my perspective, there are two roles in financial markets that definitely won't feel bored over the course of the next few years. One is if you're a salesperson for tri-party collateral management, right? And the second one, if you're a salesperson for agency lending, in a setup where you have a large client, custody client base. These are probably the points that I would like to mention when it comes to securities lending and T1 settlement. And now over to you, Kieran.
Thanks, Christian. I think what's been said by Jim and Claire and Christian, really highlights a lot of the challenges we're coming up against, right? But I think first and foremost, I think T+1 is being rolled out to be a risk reduction, hopefully a more efficient settlement market, not just for the US, but globally, where we're going to see European, UK, Swiss markets moving to T+1 as well. But I think what's been highlighted so far is that there are a lot of hurdles, challenges, and preparation to be done in advance of this happening. So obviously we've got Canada, the US, and also the Mexican market moving to T+1 in May 2024. So I cover exchange traded funds for State Street in Europe, and I've been working across the market with issuers, service providers, and some regulatory bodies to identify where the challenges are and what solutions we can come up with for supporting exchange traded funds post the T+1 rollout. So the first area I wanted to touch is around primary market interactions and the impact to the primary market for creations and redemptions, or subscriptions and redemptions. And this doesn't just apply to ETFs, it would also apply to traditional mutual funds and other product sets. So there's a couple of different scenarios, but with the US moving to T+1 for the underlying securities in a fund, if on a subscription you have the issue where you're currently settling T+2 for your subscription, but your US securities within the fund are going to settle T+1. If you settle your subscription transaction on T+2, you're going to overdraw the fund because you're going to have to cover the cost of the securities settling on T+1, the US securities. So what we've been recommending and discussing with industry is, if a fund is 100% underlying assets in US dollar, then just shift the settlement cycle of the ETF shares to T+1. So you align the settlement of the ETF securities and the underlying securities to T+1. And what we see today in the European ETF market is about between 58 and 60% of subscription activity actually already settles on T+1 in the primary market. So this shift shouldn't be massively burdensome to actually change. It may require some prospectus updates, some engagement with the investors in ETFs being authorized participants. And for non-ETF products, it's also something that I know a lot of managers are looking at. So you align your cash from the settlement of the underlying securities with the settlement of the shares. The wider challenge then on a creation comes in when you're actually got a, let's say, a global range of securities and assets and currencies in your fund. The way we've been looking at it from a solution is that the fund should always be protected first. So you should still look to settle the creation on T+1 to make sure you're not going to create an overdraft on the fund for the settlement of the US securities. Now, that obviously protects the fund. The fund will be long cash, but that cash balance will be significantly reduced by the settlement of the US securities, which for a global product is anywhere in the region of 40 to 60% typically. So that also helps to reduce the risk of any potential UCITS breaches, where you may be long cash up to 20%, or if you overdraw the fund, leveraging up to 10%. So a lot of questions have come in and around what impact is there to UCITS breaches. And what we've actually come to is that if you end up settling on T+1, which, as I said, a lot of issuers do today, the settlement of the US assets on T1 will actually reduce your exposure to a potential UCITS breach by reducing the cash balance. If you then move on to redemptions is where if you ever short settled shares on a redemption, you would typically overdraw the fund. But the move to T+1 for US securities and Canadian is actually reducing that risk of an overdraft because you're going to be long the cash for the sale of those securities. So what we've discussed across industry is that if the fund is 100% US of underlying securities, then move the redemption of the settlement of the redemption shares to T+1. And therefore you wash the cash out completely and you end up netting each other off between the ETF shares and the underlying securities. In any other event, like that global security or global product, where you might have around 60% of the exposure is not in US, you would settle the shares on the latest settlement date to avoid any overdrafts, in that you don't want to be paying out to an investor when you haven't settled all the underlying securities, which would actually cover the cost of that. Now, that depends on, how much exposure you have in those markets, how much cash you may hold in the fund, but ultimately you would align US with US on a redemption, and if you have anything else outside of US securities, you would actually settle it on T+2 or greater. So that's at a very high level, and not just ETF, but for other mutual funds and asset managers, we'd be discussing a similar solution. Now, as I said at the start, for an ETF, you've got the challenge between a primary market and a secondary market. So the primary, where the authorized participants and market makers are dealing directly with the fund, and then the secondary market, where investors are buying and selling with market makers on exchange. There's a dislocation in Europe is going to be created because of T+1 in North America. And the issue is that if you move the primary market to T+1, as I discussed, the secondary market in Europe is still going to stay T+2, certainly until Europe moves to a T+1 market. So if, number one, you're going to be asking the investor or the market maker to pay 100% of the funding up front on T+1, they're going to have an increased cost of funding, which in now a higher interest rate environment is going to cost them more money, because they're going to have to hold the shares overnight because their transaction on the secondary market won't settle until T+2. So that therefore requires an increase in funding and also a potential increase in hedging costs for the market maker, who ultimately will potentially pass that cost onward down towards the investment chain to the end investor, which is the last thing people want and investment managers want, is the end investor being impacted. It could also potentially widen spreads. It could increase failure costs, which have been heightened with the implementation of CSDR last year. So there's a significant amount of knock-on costs and operational model changes that need to be analysed as part of that change. I've already mentioned the potential for UCITS breaches, but I think that can be managed through efficient changes in the settlement date and also cash management between cash sweeps and managing the cash efficiently by the portfolio manager. But ultimately, I would say it is critical that the investment manager does stringent analysis of how they manage their cash to make sure that they're comfortable with their approach and that there will not be UCITS breaches, or if they are, how those breaches will be determined in the different regions. So the difference between Luxembourg versus Ireland versus Switzerland, Germany, the Netherlands, they're all areas which have significant ETF exposure that we've had to look at and we're working with our clients on. So if you do have exposures across different European markets, it's key to engage with your depository and also your regulator on the impacts. And then I'd just like to touch on the lack of harmonization that we have in Europe is going to be heightened due to this change in T+1. Because as was mentioned previously, you're losing 83% of the settlement window between when markets used to be T+3 and then they moved to T+1. So there is a very much a condensed approach. But we have the US, Canada and Mexico, and then potentially some other South American countries moving T+1 in 2024. We've also got the UK and Switzerland discussing or determining potentially moving T+1 in their individual markets, and then would be followed by Europe as well. So we could see an even more fragmented market, which is going to require much more operational management and currency management across those different markets. So it's key that everybody across the financial industry is planning for those eventualities. And while the US is typically North America is very much one single market, one single currency, Europe has a range of different currencies that would need to be managed, and they will all have different timelines. And as I said, there's been a potential for, we're trying to make sure is that the market is prepared for where the costs may come, and what my colleagues have said, how you can put efficiency into your model, be it through securities lending models, through FX solutions, and also through planning with your service provider, your custodian, and your administrator. And then I would just highlight that ESMA have put out a call for action and a call for evidence the week before last, which is a paper they've issued for, or a consultation they've issued for the market to respond on potential impacts of the move to T+1, not only in the US, but in other European markets. And I think it's key that investment managers, service providers, custodians, administrators all provide their feedback through the official channels to make sure there's an awareness in the market. So I'll pause there, and Jim, hand back to yourself.
Thanks, Kieran. Appreciate it. Stefan, I think we want to move towards the panel discussion section of the webinar, and we can move towards the pre-submitted questions that were submitted at the registration, and I'll start with those questions in the discussion. I can address the first couple questions that were submitted, and then we can move into, I think there were 5 pre-submitted questions that we can start with, and then we'll discuss the any questions that come through the Q&A. So to kick it off, the first question was regarding corporate events and corporate actions. How will they be processed? Still T+2, or will there be a change as well? So regarding that, the industry has indicated or has cemented the fact that the X date and record date in the U.S. market will be combined into one date. So it will be now a single date, and that has sort of a knock-on effect to the cover protect process, and it eliminates one day in the cover protect process. So that's really what's going to change as far as corporate actions go. But as far as announcements go, there will be no change. The agents in the US and Canada haven't communicated that there will be any change to that process. And so the announcement process will continue as is. As far as processing, again, it's dependent on the one date now that will X date and record date will be the same. And so the next question is, do we know the deadlines when the instructions need to be placed in the market? Is it 9 p.m. on trade date? Well, that's not, that technically is not the deadline. That is actually 9 p.m. is actually on trade date is actually the affirmation deadline that DTC has communicated to the marketplace. In order to have the trade, as I discussed earlier, affirmed in the marketplace, agreed to with the executing broker and the buy side, that needs to be communicated to your custodian by their cutoff time, which is around the 9 p.m. time. The instructions being placed in the market still remains the same. The deadline to the market is still the same as it is today. What's being eliminated is one day before the settlement date. And so the middle date between T+2 is technically being eliminated. Hopefully that answers that question. The next question is, what will be the new market cutoff for trade affirmation and instructions to the custodian beyond May 24th, 2024 in the US, Canada, and Mexico? Well, I'll first address Canada and Mexico. We still are waiting for information from the regulators and the depositories and our sub-custodian in Mexico with regards to what cutoff times will be and deadlines. We expect those to be to us shortly. In the US, the trade affirmation deadline, as I alluded to in the earlier question, is 9 p.m. Eastern Standard Time on trade date. The cutoff to the custodian in most custodians at this point is either 8:30 p.m. On trade date or 8:45 p.m., allowing for 15 minutes or 30 minutes to process the affirmation through to down to the depository. Next question is, what about penalties, claims in the accounts if the accounts are short of cash? I assume this is related to similar to CSDR. There won't be any penalties per se for not affirming the trade, but if an account is short cash, wherever your cash account resides, there will be that short of cash will be subject to an overdraft charge. And then the fifth question here is DTC Fedwire planning to implement status updates MT548 for the pending trades to see on time if an issue occurs on settlement? The answer is yes. MT548 will still continue in and provide status on trade settlement going forward. And with some of the upgrades that we're making internally, there's more real-time information coming from our internal systems and interfaces with the depository. So the answer is yes, with that question. So moving on to question number 2. This is kind of regarding investment guidelines, monitoring costs due to mismatches and so forth. And I think, Kieran, if I could lean on you for a little bit of this, if you don't mind. The first question is, I think you alluded to a lot of this in your discussion, in your presentation, in respect of cash long or short because of market change. It is our understanding that cash and borrowing limits as set forth in the fund contract are binding and cannot be waived even for one day. Also, if they are the result of this inevitable market change, as a result, this will be classified as an active breach, and any loss need to be covered by the investment manager. I don't know if you
Jim, I can jump in there. So
Sure.
yeah, I touched on it briefly from a European perspective on a UCITS breach, right? So again, it very much depends on which market you're operating in. So as I said, and it also depends on your depository. So for any asset manager with concerns over potential regulatory breaches, I would engage directly with your depository to determine how they will treat such events. Because from speaking to industry, at a depository by depository basis, they can be treated differently. So, and when I say depository, I'm talking State Street versus a JP Morgan versus a Citi, etc. So there may be a different view on what an advertent versus an inadvertent breach is. And then also from a regulatory perspective in Ireland versus, let's say, Germany or Luxembourg, Luxembourg may treat something as an active breach, such as a long cash balance due to a decision made by an investment manager, whereas some of the depositories in Ireland would treat that as an inadvertent breach. So there's no one size fits all for this question, but that goes back to what I was saying earlier. Number one, you need to manage the cash efficiently, right? And that's where adjusting settlement dates really helps to solve that problem. If that's not done, the fund will incur an overdraft, and obviously the fund or the manager itself will be penalized depending on the arrangement with the custodian. And third, it's understanding the regulatory requirements in the market. But yeah, there's no difference. There'll be no exceptions made for the fact that the US is moving to this. It's not European regulation. Ultimately, it's about efficient cash management and making sure you adhere to the guidelines.
Thank you. And so further to that, there's a part B on this question. Such practice would need to be disclosed in a fund contract, a prospectus. Is that
I don't think the practice is going to change anything specifically for managing the cash, but if you're going to be amending settlement dates, now I've looked at a few supplements and prospectuses for some of our clients and just in the market. And when it comes to the actual settlement date, they typically put the maximum settlement date. So, a subscription needs to be settled within T+3, or redemption needs to be settled within T+4, etc. So that doesn't really need to be amended. You just need to make sure that if you are moving to T+1 and you're very prescriptive in those documents, that it gets updated. It shouldn't if you're not prescriptive to the exact date. But you would need to be amending the surrounding architecture you use for taking in your investment activity.
Okay, thank you. And then there's another question, somewhat similar, in respect of cash long as a result of the market change. Example, the investment manager sells securities in Canada, US on trade date of the fund, with the result of the fund cash account being long for one day. Is our understanding that investing this long balance for one day in a money market instrument, for example, would be considered leverage. Also, if a result of in result of the market change, this will be will it be classified as an active breach, I guess?
Yeah, so obviously the US settling early on a redemption is going to leave you long cash, right?
Yeah,
So you've up
yeah.
to your 20% limits, which is fine. Yes, there are solutions to invest in money markets, but that's not considered sweeping the money, right? It's still owned by the fund. So we understand you're still held, the manager or the fund is still held by the same limitations that you can only hold a certain percentage of one product. So if you are over that usage threshold, you may need to sweep into a number of products or into a money market vehicle and some sort of overnight sweep, because you can only invest a certain portion into any one individual product.
Okay, thank you. And then there's a third question here in respect of trade date differences as a result of the market change. If the investment manager would wait for 1 day with the divestments to bring the settlement cycle of the underlying trades in Canada, US in line with the settlement cycle of the fund, it is our understanding correct that requirements regarding investment degree, leverage, minimum and maximum allocation limits as set forth in the fund contract are binding. Also, if they are the result of an inevitable market change, as a result, this will be classified as an active breach. Any loss needs to be covered by the investment manager. So I think it's kind of similar to what you answered before. Similar kind of a topic.
Similar question, and yeah, similar response. So there's no waivers just because of the US moving. And what was the first part of that again? I'm sorry, I had.
Yeah, sure. The first part is regarding investments, leverage, minimum and maximum allocation limits as set forth in the fund.
Oh, sorry. Yeah, it was around the
binding.
redemption. Sorry, it was around trading, waiting a day to trade.
Right.
That is something that has been discussed, right? That you try and align them, but you're obviously taking an exposure there to. And again, I'm really looking at this from like an index and ETF product perspective. Typically, you want to be trading at the end of day price that you've received the order for. So if you're going to hold off a day, you're potentially going to trade at a different price, right? So potential fund or investor impact. What we have heard discussed, and this isn't really in Europe, it's more in the US, but is to try and align, do exactly that, right? So don't place your primary market order until the following day to align it to the secondary market activity in Europe. Now, that is an option to do that, but again, there's a risk and exposure of holding off on your investments due to obviously market movements. And secondary, it's actually the management of that would be operationally managing it, I suspect would be very challenging. It's a struggle enough today to make sure you align your investment with the investor flows. So to actually start holding them off, certainly what we've looked at from exchange traded products where there is the primary and secondary, while it could be done, and it is an option, it would take a lot of operational management on the investment manager to be holding back on investing, albeit they've received an order in today. And obviously they've received it in today, so there needs to be some level of hedging done off the back of that as well. So yeah, I think it is an option, but would be challenging to manage, is what we're hearing.
Great, thanks. And then just one other point on this regarding costs and the like. Would additional costs, debit interest, or short balances arising from the market change be eligible to be charged to the fund under the clause that transactions related costs are borne by the fund in general? So I guess if there's any debit interest or caused by short balances, is the fund able to absorb those costs due to the market change?
Yeah, the questions come up, Jim. It's not obviously issuers and investment managers would need to look at their regulatory documentation on how they treat such events. I mean, we do see that done in other instances where, a market event may cause debit interest and it does get applied to the fund, but then you need to look at, performance, you need to look at negatively impacting shareholders, etc., due to a market event. So Yeah, I think that's probably worth looking at between a manager and either their documentation or their legal advisors as well. It will also depend on the location. I know from CSDR, fund debit interest or debit impacts cannot be applied in certain markets to the fund. I believe Germany and potentially Switzerland are other examples. So, it's going to depend on market by market as well.
Right. And does something like that need to be disclosed in the prospectus, do you think? Do you know?
I don't know what level of granularity, but I suspect the prospectus would have wording around how such events are treated today.
Right. Okay.
Again, probably one from a legal advisor perspective to opine on.
Yeah. Yep. Sure. Okay. Turning to question number 3, which is related to securities lending. And Christian, I'll lean on you for this. First question is, will the market agreements with borrowers need to be updated, or are the standard GM SLA explicit enough that applicable market cutoffs apply for the delivery or return of a loan or collateral?
I would say they're not explicit enough to not need to be updated, so to say, right? So in fact, like there is no direction to like cutoff times in there. Like, I mean, cutoff times is a good point, right? There will be an effect on cutoff times. That's for sure, right? The market is still debating a bit like what is the best practice, but securities finance, in contrast to some other business, there's not like, okay, you have like an 8:45 or 8:40 cutoff time. It's more like, okay, we work quite a lot on a best effort basis. When you look into an agency program, that's probably the difference to principle. You need to, at one point of time, make a cutoff, said, okay, until this time, I need to know if you have sold your shares or not, because I need to go out then to the borrower. And I would say, like, I think so far the cutoff time is somewhere around, don't nail me on this, like 3 p.m. on like T1. And this will be moved like to the prior day, so to say, right? Because I cannot work on a 3 p.m. Cutoff time if I have to settle on the same day. That does not work. But the GMSLA, I would say, is not affected, no.
Okay. Yeah, and I know the loan recall time frame, cutoff time is really a hot topic in the industry from the borrower segment. And
to say that, in addition, James, just like to quickly hook in, it opens opportunity as well. So it's not only, oh, T+1 is like a big operational burden. It opens opportunity because there will be counterparts say like, I desperately need assets, right? Could you lend them to me? Because I need to settle. And that's where like, like my father used to say, like, if the door closed, have like hammer and nails at hand to make sure it really stays closed, right? And this is the situation we have here as well, probably.
Yep. Yeah. And yeah, when you talk about recalls, what's, are you seeing anything in the market with regards to where the industry is leaning towards? Have you heard any industry intelligence on where they would potentially be leading for a cutoff time, or is it still very up in the air?
It's too early to put a number into the room, right?
Okay.
But like discussions are going around that, and like, when you shorten like the settlement periods on the return on the sales cycle, right? You also shorten it on the return cycle. So far it's like standard is T2, right? Even though we tried T1 or T0, like on a best effort basis, as I said, like in the beginning when we went through the slides. But if you shorten that to T1 and you shorten the other one to T1 as well, there's literally no difference to today, right? The only thing is like, 10% early on 48 hours is a different time than 10% early on 24 hours. So that might make the difference. So I would expect having something late evening at T0 as a cutoff time, but nothing decided yet.
Okay, thank you. And then the second question under securities lending, what will be the cutoffs regarding the timely recall of loans in order to not be short to deliver on settlement date. So that's kind of what we just addressed. It's you know,
actually that's the point. It's like you shorten the settlement cycle on the sale side. You also shorten the settlement cycle on the borrower return. Like the point is like and this again, there is a big advantage, and I'm talking my book here, but there's a big advantage in agency lending. Agency lending usually are large, massive programs, like
right.
and State Street in particular, right? And there's probably another big global custodian who has a similar size than we do have, right? And they would give you similar numbers. Is if someone in our program is selling assets, in 98% of the cases, we are able to replace these assets out of the program. So we do not worry about the settlement cycle at all. And only for the remaining 2% or 3%, we are then starting to think, okay, what could be the cutoff time? But that doesn't matter, that there needs to be a formal cutoff time, because at one point of time you get probably settlement fines. And when this kicks in, you want to be very clear, okay, has someone recalled prior to the cutoff or after the cutoff? But it's not decided yet.
Okay, thank you. So moving to question number 4, again, Kieran, it's back to you again, with ETFs again. The first question is, will there be a difference for US ETFs between settlement date for primary market CNLs and secondary market trades, or will both settle T+1 beyond May 2024?
Yeah, I think that's a point I touched on earlier. So
yeah.
the secondary market will remain T+2 in Europe, where primary, certainly where there's US assets on creations, will move to T+1. So that's that dislocation I was referring to, where the market maker may have to sit on those assets, the ETF shares, for a day before they distribute them across the secondary market. So that dislocation and fragmentation will certainly cause issues. And then on the redemption side, same thing, right? If you receive a redemption, and this goes back to the question that was raised earlier, is there a potential to hold off? You may take a redemption in the secondary market, knowing it's going to settle T+2, but not place it until the following day because it'll settle T+1 to line them up.
Right.
What the market maker needs to make sure is that they can get the shares back to the fund on time. So if the fund needs them on T+1, the market maker is potentially going to have to delay that order or deliberately fail it and charge extra in the secondary market. So yeah, there's that dislocation until Europe aligns to T+1.
Thank you. And then further to that, will a UCITS ETF holding US securities need to follow the same route?
Yeah, I mean, that's what I was saying earlier,
yeah.
right? So depending on your cash management approach, but you will lead to overdrafts if you allow the US securities settle T1 and your investment flow not to settle until T+2. And on the redemption side, you're actually in a better position because you're not going to overdraw. You'll actually end up with a long cash balance, but it's not going to be the cash balance related to the overall redemption. It's just going to be the underlying US component. So look, there's potential to overdraw secondary. You could potentially look for line of credit, but line of credits really aren't for day-to-day overdrafts. You know, they're for one-off or upcoming events that you know that are going to happen. So again, it's about the effective cash management, adjusting the settlement date on your investment of the shares of the product to align with the US settlement. And as I said at the start, number one, protecting the fund and the investors is key.
Great, thank you. I just taken a look at the questions. I've only if participants want to submit their questions, please do. Happy to answer any questions going forward. So just continuing on with the pre-submitted questions. Number 5 that we got was related to threshold of applicability. And I don't know, this is kind of a 3-part question that maybe, Kieran, I think this, again, back to you again. Maybe, you know, you may have addressed some of this already, but between the fund subscription / redemption cycle and the settlement cycle of the underlying assets, there will be a mismatch. To shorten the NAV sub-red cycle by 1 day is likely to happen. And if yes, number one, what would be the USCA, US, Canada, Mexico exposure threshold that will trigger this change? And how will this be handled when the mix changed?
Yeah, so I think we've answered it at a
Yeah.
high level that, yes, there'll definitely potentially be a need to readjust the settlement to T1 on creates and T1 on redeems if it's 100% US, otherwise T2 plus. What's the threshold? I suppose really depends on the manager and the product, right? So
Right.
from an ETF perspective, product like an ETF will never, well, will hold limited cash balance, right? Limited cash exposure. So the likelihood of being overdrawn, if you, let's say if you had 5% US exposure and that settled T1 versus the share fund share settling T2 is going to cause you an overdraft. But if you've got a mutual fund that sits long US dollars, then you can potentially cover that cost up to a certain, or cover the cost of the investment up to a certain percentage. So we very much in the working group across Europe taken a bit of a blanket approach that if you have, and because ETFs, you either have little or no US exposure, or you go for a global product which has 40 to 60, right up to 100% with, you know, US only, like your S&P 500. So we've taken a bit of a blanket approach that if you have US exposure on a creation, you move it to T+1. If you have only US exposure on a redemption, you move the redemption fund shares to T1. If you have anything outside of US exposure on the redemption, you leave it at T+2 or beyond because you're running the risk of paying out redemption proceeds, which the fund has yet raised. So that's been the approach. Again, I'll go back to the protect the fund first
Right.
view on that. But again, that's at the manager's discretion about how they want to manage their cash and what level of potential overdraft or what cash buffer they may sit on within the fund to address such an item. I mean, the alternative is if they're using cash sweeps or money market products, they could sweep money back out of that to cover the cost of the redemption and allow it to settle. And then the actual sale of the underlying assets that settle after that, you know, then sweep that back into a money market or a cash sweep. So there's different approaches, but
Right.
yeah.
Okay. And then, so the second part of this question is, if it falls below the threshold or reaches the threshold, you know, what, I mean, I think you probably addressed that already.
Yeah, again, that's at the manager's discretion as to what they
Right.
want to do. Do they just create a small overdraft, or do they, you know, sweep cash from elsewhere, or do they just not allow it to happen? You know, and all of that will come in your fund legals and agreed with your board, etc. It's going to depend product by product. I don't think there's any kind of catch-all for that.
Yeah, and I think the third part of the question is you know, more I think you've addressed as well. It's really on what securities, example, North American securities. There are opinions discussed with exposure when the exposure is at 70 to 80%, but also more than 50%.
Yeah, and there's like the market's not going to put a, you know, the market's not going to put a limit on it. It'll be up to the investment manager and the issuers themselves to determine it. So I don't think the market's going to come out and say, well, if you've over 50% or under 50%, do this or do that. It's very much agreeing your operating model and ultimately what the investment manager is comfortable with, but also operating within regulatory guidelines.
Okay, excellent. Okay. I just want to remind participants, if they want to submit any questions, please put them in the Q&A. So
I think there's one there on ETFs, actually.
Yep. If you want to address that, that would be great, Kieran.
Yeah. So the question is, if primary market settlements for UCITS ETFs shorten to T+1, how should that work when NAVs are only calculated and published on settlement date? So the NAV is actually calculated and published every day. So if you place a primary market order today, which is the 25th, you get the NAV of the 25th. So albeit settlement date might be the following day or 2 days later, the NAV is actually calculated on the trade date, and that's the NAV you get of the product. So shouldn't be an issue there.
Okay, thanks. And then there's another question here. Is there any impact expected on the settlement of bonds issued by U.S. issuers? And I think I can take that. So the way to look at it is really any product that's settling in DTC will be subject to T+1, and that includes U.S. corporate bonds and U.S. municipal bonds. So hopefully that answers that question. Currently, those are in the T+2 settlement regime, and so those will be moving to T+1 because they do settle in DTC. The U.S. government market is already T+1 and settles through the Federal Reserve. I'm seeing another question here. What solutions do you see here to deal with settlement differences in mixed funds? Let's assume the equity fund with 50% of assets is in U.S. Canadian equities with T+1 and 50% of the assets in equities that will settle in T+2 on a day with large net flows, subscription or redemptions. The divestment of the underlying asset will cause a technical liquidity mismatch from T+1 to T+2, resulting in overdrafts or cash deposits for one day, potentially exceeding breaching giving thresholds, cash counterparty credit limits. Kieran, could you take that?
Yeah, I think it's similar to what we've gone over, right? So that's assuming like it's you know a multi-asset, well, multi-market product with US, Canada, euros, etc. So as I said, the approach that we've been looking at and just discussing is on a creation, take in 100% of the value, and obviously like it's going to be reduced. So as I said, about 50+% of our ETF creations are settled in T+1 today, right? Which creates a long cash balance for the value of the ETF shares. Now, in this example, it's actually going to get reduced by the settlement of the US asset. So the risk of a regulatory or usage breach is actually reduced. I do take the point that obviously it references large inflows or outflows. And that's, where you potentially might need to use a number of money market products. But I suppose it's worthwhile issuers doing the analysis of how often they would see that scenario today where there would be a regulatory breach, because you're talking huge inflows or outflows on a small product, or if it's a large existing product, gigantic flows, right, to actually hit the usage breaches as well. So it is about managing that cash. I mean, there is an alternative you could use, but it's not really operationally scalable, is partially settling the shares of the fund, right? So if you settled in that example 50% US on day one on T+1, is there an option to actually issue 50% of the shares at the same time? And then when the following day, when everything else settles, issue the other 50%. But I mean, that's a completely unique scenario, which I'm not saying we haven't seen. We have in very, very stressed scenarios or huge order sizes. But you couldn't really operate that as a principle, right? Where you're effectively splitting your order into two pieces. So
right.
There's another option, well, not to this, right? But going back to what we said about, can you let the fund take the impact? There's also the potential option for, applying similar to like an anti-dilution levy. Could you potentially put that as a spread, like, the potential overdraft onto the actual value that you're charging the investor, that they cover the costs? So again, you're protecting your investors coming in, or the investors in the fund, and you're charging the investor coming in. But again, it just depends on how the manager wants to treat it, and while adhering to regulatory guidelines.
Right. Okay, thanks for that. Stefan, I'm not seeing any more questions. If anybody on the webinar wants to one last shot at questions, happy to take anything else. I don't see any more.
Maybe I can answer one administrative question that came in, that is regarding if we will share the recording of this session to the registered participants. Yes, we will do so. We will send an email to registered participants with the presentation, as well as with the link to recording on the AMAS homepage. I think this will be sent out by tomorrow. So the participants will receive both the presentation as well as the recording of the session.
Okay, I just saw another question come in, Stefan, so we can address that. Could we explain the scope of instruments that are affected, not affected, bonds versus equity, ADRs, etc.? Well, yeah, I mean, again, that's back to really in the US, it's really anything that currently is settling in DTC as a depository. And as I alluded to before, that would be corporate bonds, municipal bonds, equities, ADRs, the likes, and so that's about what covers it. I don't have the full listing in front of me, but I guess the way to think about it is really any product that settles in DTC currently right now. And I will just highlight the fact that DTC has a dedicated UST1.org website that they've created in order to address T+1. There's tons of material on there, and product guides, testing documents, anything to do associated with the conversion to T+1 is located there. And I believe there's a listing of all the entire product listing there. As far as Canada goes, there is a page on the CCMA, the Canadian Capital Markets Association website, that is dedicated to T+1 and lists everything that's going on in the working group and all the products that are included there. Some of the Canadian government bonds are included in the T+1 initiative. I believe it's 3 years and greater for maturity, the long-term bonds. And then of course equity and the likes. Anything that's settling in CDS, the Canadian Depository System, it will be included in T+1. I can provide the links to those two particular sites that I mentioned just previously, the CCMA and the DTC UST1.org, to the AMAS, and you can forward that on to the membership. Does that sound perfect, Stefan?
Yes, that sounds very, very perfect to me, James. That's highly appreciated, and I will include these links also in the email to the participants tomorrow. That's great. Thank you very much.
Great.
Well, and if no more questions are coming in, I think that's the case. I want to say again a big thank you to all of you speaking today. It was a great pleasure having you here on this venue, and many thanks that you gave us so interesting and exciting insights into how you are addressing the shortening of the settlement cycle to T+1. It was a great pleasure to have you here on board.